Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me.
Yeah, absolutely. I want to start by just acknowledging something that I think a lot of you listening are probably feeling right now, which is that investing today just feels, it feels incredibly overwhelming.
Oh, completely. It's chaotic.
Right. It's chaotic. You go to check your 401k or your brokerage app, and it feels less like you're building wealth and more like you just walked onto a Vegas casino floor.
Yeah, the flashing lights, the wild swings. It's a lot for a beginner to process.
Exactly. And we came across this really profound observation from Warren Buffett. This was at the 2025 Berkshire Hathaway annual meeting.
Oh, yeah, the cathedral analogy.
Yes,
You know,
it's such a perfect way to look at it. He basically described American capitalism as this marvelous cathedral of productivity. Just a beautiful, structurally sound building. But, and here's the catch, he said that attached right next to that quiet cathedral, someone went and built a huge casino.
yeah, and the casino is so loud that people forget the cathedral is even there.
Exactly. So our mission for this deep dive today, based on some really recent analysis of the market in April 2026, is to help you, the everyday investor, tell the difference between the two. Because that wall between them has completely blurred.
It really has. I mean, we are going to look at what exactly makes up the cathedral today and what makes up the casino so you can actually protect your money.
Okay, let's unpack this. Because before we get distracted by the casino, we really need to look at why the foundational economy, the cathedral, is actually still incredibly strong.
It is. The fundamentals are remarkably solid right now.
Right. So think of the cathedral like a local bakery, just a beloved bakery in your hometown.
I like that analogy.
Yeah, so they're expanding the menu, they're hiring more bakers, selling more bread every single year. But outside, there's this loud, crazy carnival. People are throwing darts, losing their shirts.
Screaming.
Yeah. But inside the bakery, the ovens are hot, right? The cash register is ringing. The noise outside doesn't actually change the quality of the bread they're baking.
No, it doesn't at all. And when we look at the data for the companies inside that bakery, corporate profits are doing great. I mean, all 11 sectors of the S&P 500 are expected to see profit growth in 2026.
Wait, all 11? Because I feel like for the longest time, it was just a few tech companies doing all the heavy lifting.
Right, the Magnificent Seven.
Yeah, exactly. Everyone was just obsessed with those 7 giant monopolies.
Well, what's fascinating here is that the rest of the market is finally catching up. So yes, those tech giants are still seeing massive growth. Recent data puts them at about 23.5% growth.
Which is huge.
It's huge. But the other 493 companies in the S&P, they're catching up with a really solid 13% growth rate.
Wow, 13% for the rest of the pack. So the foundation is just getting much broader.
Exactly. It's much wider and much more stable than it was a couple years ago.
But how do we square that with, the macro fears? Like, inflation is still a concern. We have the ongoing war in the Middle East. It feels like the world is pretty fragile.
It does feel fragile, but interestingly, that's actually driving capital into the U.S. cathedral.
Yeah.
Despite the inflation fears and the Middle East conflict, early April data showed global equity funds saw 2 straight weeks of inflows.
Really? Into U.S. stocks specifically?
Yeah, over $7 billion flowed specifically into U.S. stock funds. When things look scary globally, people put their money in the safest, most productive place they can find.
And that's American corporate earnings.
Right.
But what about tech valuations? Because a lot of people see the AI boom and think, okay, this is just a bubble. It's just hype.
Institutions like Goldman Sachs and UBS.
I don't know.
But this is, as of early April, they actually maintain that tech valuations are still attractive.
Because it's real revenue.
Exactly. It's driven by real AI expansion, actual efficiency gains. It's not just a story anymore. And there's another piece to the cathedral that's really important for beginners right now, which is interest rates.
Oh, right. The Fed.
Yeah. Futures markets from around April 10th show the Fed will likely hold rates steady through 2026.
So break that down for someone just starting out. Why is holding rates steady a good thing for them?
Because safe cash and short-term bonds actually pay you to wait right now. You don't have to take wild risks just to beat inflation anymore.
Because you can actually get a decent yield on cash.
Exactly.
Yeah.
As Buffett says, your biggest advantage is the ability to sit still.
Okay, but here's where it gets really interesting. Because sitting still is psychologically agonizing when there's a literal carnival outside the bakery.
So hard. The FOMO's real.
Yeah. If the underlying economy is so solid, why do the markets feel so erratic? Why are we seeing these wild swings every day?
Well, that is the casino. And the casino isn't just a separate building anymore. It's bolted onto the side of the market.
Right, the gamified Wall Street.
Totally.
So let me give you guys an analogy for this. Think about leveraged single stock ETFs. Using these is basically like strapping a rocket engine to a riding lawnmower.
That's exactly what it is.
Right. Like, it's incredibly thrilling for about 5 seconds, but you are almost mathematically guaranteed to crash.
You are, because these products, they allow people to place massive one-day directional bets on a single company.
And the growth in these things is just staggering. Based on recent analysis since January 2025, these leveraged single-stock ETFs have surged 318%.
It's unbelievable.
Yeah, there are like 355 different products out there now just for this.
And here's the craziest part. Nearly 90% of this trading is done by regular retail investors.
Wait, 90%? It's not hedge funds?
No, it's everyday people treating the stock market like a sports betting app. These products now make up 8% of all U.S. trades.
That is wild. I mean, think back to the tariff shocks we had in April 2025.
Oh yeah, the volume there was insane.
It was. During those tariff shocks, these leveraged bets accounted for an unbelievable 40% of the entire market volume.
40%. That means the people betting on the volatility were almost as big as the actual market itself.
Which is terrifying. And it's not just ETFs, right? We have things like Kalshi now.
Right, prediction markets.
Yeah, they are turning literally everything into a financial derivative. Elections, sports, whatever.
And this just got supercharged. On April 6th, a court ruled that the CFTC, the Commodity Futures Trading Commission, actually has jurisdiction over sports betting contracts.
So wait, they officially brought sports betting into the regulated financial markets?
Exactly. The casino is officially in the house. Even traditional exchanges like Cboe are considering what they call all-or-none options.
What does that mean, all or none?
It's a pure gambling structure. You bet on a stock hitting a specific price. If it hits, you get a fixed payout. If it misses by a penny, you get zero.
Wow. So it's literally just putting it all on black?
Yes. Everyday investors are no longer analyzing companies. They're just trading the volatility itself.
Like what we saw with Asian retail investors back in March.
Right. Buying U.S. energy stocks on margin right during the energy shocks from the war.
They didn't care about the long-term health of the oil companies.
Not at all. Or look at the crowded trades in silver ETFs. People are just chasing the chart. They're not investing in silver's industrial use.
Okay, but let me push back for a second, because it's really easy to just blame everyday retail traders, right? To say they're treating it like a casino.
Sure.
But isn't speculation just human nature? Like, why is this suddenly such a critical, systemic issue in 2026?
This raises an important question, because you're right, it's not just retail traders. The casino mentality has crept into the highest levels of policy and government.
Oh, absolutely. I mean, look at the reports that came out in April. On April 9th, the White House literally had to email their staff to warn them about suspicious market bets.
Yeah, related to Iran war policy decisions.
Right. There were these massive oil bets placed right before an Iran ceasefire announcement.
And we should be very clear here. We are not taking political sides on this at all, not regarding the current administration, President Trump's policies, or the Middle East conflict.
Exactly. Completely neutral. We are just reporting on the data.
Right. The data shows that speculators are treating geopolitical events like casino games. We saw similar perfectly timed options bets happen repeatedly right before President Trump's policy announcements in 2025.
It's like they have insider knowledge and they just use the casino to cash in on it.
Exactly. And governments are actually relying on this casino too.
Oh, you mean like the tax revenue issue?
Yeah. Back in March, several African nations pushed to raise taxes on online gambling.
Which makes sense. They're worried about addiction.
They are, but it highlights this crazy paradox. They are terrified of the societal impact of gambling addiction, but they desperately need the tax revenue to fund their governments.
So they can't afford to actually shut the casino down?
No, they're addicted to the revenue just as much as the players are addicted to the games.
Wow. Okay, so what does this all mean for the listener?
That's the million-dollar question.
Right, because if you're a beginner American investor, you're looking at a market that is this weird mix of real solid economic growth cathedral and wild politically charged gambling, the casino. How do you navigate that?
Carefully. Very carefully.
Yeah. So think about investing right now, like you're driving on a highway. The cathedral is your GPS, right? It's taking you to your long-term destination.
I like that.
And the casino, those are the flashing billboards on the side of the highway. just begging you to pull off at the next exit and buy a lottery ticket.
And you have to ignore the billboards.
Exactly. So what is the actual playbook here, based on all this data?
First thing, you have to consciously separate your assets.
Like, physically put them in different buckets.
Mentally and practically, yes. You have your cathedral bucket. This is for long-term cash flow, market dominance, companies where time is on your side.
Index funds, blue chips, that kind of thing.
Exactly. And if you absolutely must play in the casino using short expirations, high leverage, all or nothing bets, that needs to be completely separate.
Right. With money, you are 100% okay losing.
Yes. Second, you have to filter the noise.
Because it's loud out there.
It is. You have to recognize that when you see a great tech company's price moving wildly on a Tuesday afternoon, that is a mix of real AI fundamentals and pure casino noise.
Right. It might just be a leveraged ETF rebalancing, not an actual problem with the company.
Precisely. Which leads to the third rule. Decrease your trading frequency.
Just check the app less often.
Yeah, honestly. In a market where headlines and prediction markets cause these wild daily swings, the volatility itself isn't your biggest risk.
Oh, that's interesting. What is?
Your reaction to it. Changing your strategy too often because you get spooked by a headline or a sudden drop.
So you just have to sit on your hands.
If we connect this to the bigger picture, the U.S. economy remains incredibly robust. The secret isn't to flee the market out of fear.
Right. You don't abandon the bakery just because the carnival is loud.
Exactly. You just cultivate the discipline to stick to productive assets.
As Buffett's wisdom tells us today, wealth is built in the cathedral, but bankruptcy happens in the casino.
That is perfectly said. So look at your own portfolio or your own financial goals today. Are you investing in the durability of the building? Or are you just getting distracted by the flashing lights and the noise of the slot machines? It really is time to decide which door you're walking through.
Absolutely.
Well, that's all the time we have for today's discussion. Don't forget to subscribe and hit that like button.